Hi there, I'm Tyler Ballhorn. Welcome to the Stock Scores Market Analysis for May 10th, 2010. Starting off this week, we're going to log into the trading desk that can be found at tradingdesk.stockscores.com. Once in the trading desk, I'm going to jump over to the Chart Watch area, and it is in the Chart Watch area where I can pull up the key list of stocks that I want to monitor for everyone to consider. To do this, I clicked on the Market Minutes watch list over on the right-hand side of the screen, and that brings up the list of stocks that I like to take a look at every week, starting off with the Dow 30 ETF, symbol DIA. You can see here we have a good long-term upward trend, but of course last week we had a very abnormal bit of market action that took the market back dramatically through our long-term upward trend line. Now today, and that being Monday, the market gapped up on news that there was a bailout underway in Europe, and that took the stock markets back above this long-term upward trend line. So it's a little bit of a difficult situation because we did get a break of that upward trend line. However, we gapped back up to come through it. The way I would trade the market now is with some caution. There's a lot of volatility, and I think that we could still break this long-term upward trend line. So keep a very close eye on the market to see how well it can hold above that blue line that I have drawn on the chart. Now here we have a chart of the Canadian dollar, and again the sell-off last week hurt the Canadian dollar as well as money went into the US dollar as a safe haven. The news today caused the Canadian dollar to gap up pretty dramatically, and I expect that we will continue to stay in an optimistic pattern on the Canadian dollar, and I would continue to be favoring the Canadian dollar globally. Now, gold did not go down considerably on the news today, which you would sort of expect since it rose up in relationship to the problems going on in Europe. Now, we do have the buyers in control here. You can see that the bottoms are rising. The steepness of the climb is increasing over time. However, we are coming into resistance at the highs that gold set last December, and my expectation is that gold will probably top out here in the short term and either fade back as political concerns go away and global economic concerns go away, or consolidate sideways for a while. However, I don't think there is considerable upside in the short term for gold to break through that level of resistance. It will likely get stuck there in the near term. Now, oil got pretty beat up last week. Again, the problems in Europe caused strength in the US dollar. That hurt oil prices since it became more expensive to buy oil, and we saw the price of oil drop back fairly significantly in a short-term move. However, keep in mind that this chart remains stuck in that sideways trading range, and there's really no reason to be negative about oil because the cycle of rising bottoms continues. Now, given that we are at support at that upward trend line, my expectation is that oil probably rallies over the next little while unless we get some sort of surprise out of Europe. However, my expectation is we're probably going to meander back up towards the upper part of this range, and that should help oil stocks. But until we ultimately get a breakout through that long-term resistance, don't expect anything great in the energy market. Here we have the chart for the NASDAQ 100, and just like we saw on the Dow and just like we will see on the S&P, the pullback last week went through the upward trend line, but today we gapped up above it. So I'm going to stay bullish for now, but with some caution because I don't like how that broke. However, when you think about the circumstances that caused the break of that trend line, it is understandable that we might get a gap back up as some of these problems get solved. And here is the chart of the S&P 500. Again, upward trend line broken for one day. We gap back up above it. So stay long, stay bullish, but remain with trading with some caution in the near term. The TSX fared much better than the US markets. The Toronto Stock Exchange did not break its upward trend line. It did not have the computer problems that the US exchanges had. And we remain sort of stuck in this trading range. It's not a perfect ascending triangle, but it is an optimistic pattern that is building. Ultimately, if the US dollar can weaken, which would help commodities like oil, we should see the Canadian dollar break out. I do like this market longer term, but it still needs to make that decisive break through resistance, which it has failed to do thus far. And finally, here is a chart of the US dollar index, which is the US dollar relative to global currencies, particularly something like the euro. We can see that we've really run away from the upward trend line over the last few days. The US dollar broke its short-term pessimism right about in there, and then rallied on the problems that Europeans were having with different countries potentially defaulting on their debt. We have run away from that trend line, so my expectation is that we pull back to it, but looking beyond a pullback, the market does look favorable and that the buyers seem to be in control. Just expect some short-term weakness as some of the emotion comes out of the market. Well, that has been the StockScore's market analysis for May 10th, 2010. For more information on the tools and services offered by StockScores, I encourage you to visit us at www.stockscores.com. Have a great week in the market and